Hello and welcome to another episode from the Level Up Financial Podcast. Lovely to see you all, and Jax, as usual, lovely to see you. How are you today?
Peter, man, I'm doing well, doing very well. Do you know what? It's been here in the UK. It's been really hot. It hasn't rained for a very long time. I don't know if you've realised, but if you look outside, a lot of the grass is turning yellow. It's ridiculous.
Listen, I sent you a video the other day of, and there was a little field fire near mine as well, man. So it's just been a massive drought out here. But you know what, man? We can't complain. I've been telling everyone, no one can't say English weather this year has been rubbish. It's been hot, man. So
Yeah.
we celebrate and we move and we enjoy the weather whilst we have it, man. But yeah, no, definitely good to see you and good to see you for another episode as well under our belt. For our listeners here, a massive shout out and welcome to you all. Some of you, if you're tuning for the first time, this might be the second Level Up Financial Education episode just seen on YouTube. But for our long-time listeners, as you may know, we've recently rebranded. So we used to be called Woke Finance or the Woke Finance Podcast. We've got over 250 episodes.
Wow.
We encourage you to tune in, jump on those episodes. We're on Spotify, Apple Podcasts, all of that good stuff as well. But now we're officially Level Up Financial. So yeah, man, you can stay tuned with us, and we've got another episode in store for you all, man.
Yeah, man, very exciting episode. I'm going through a season of kind of doing some changes in my house. We've done the bathroom, so we've renovated the bathroom. We've done a whole bunch of stuff. And in recent times, we had our carpet cleaned. We had a carpet
Mm.
cleaner literally this weekend, so just a few days ago. And yeah, I think that was the basis of this podcast episode. So it'd be very
The
exciting to
word.
talk about the conversation I had with my carpet cleaner. Yeah.
Yeah, nah, man, and this, you know what, this is what inspires these episodes. Whenever me and Jax or anyone in the team, whenever we're going out, whether it's the schools, different parts of the community, bumping into people or engaging with our community online, we hear all sorts of conversations that is just relevant to everyday living and our lives, and it revolves in those conversations. It revolves around personal finance. And it's always so interesting. You might come across some conversations where you realize people actually believe these things because of it could be upbringing, they
Yeah.
might have just heard something, or maybe they've not been educated in certain areas. So, and this is, one of many of those topics. So, Jats, will be good and interesting for maybe if you don't mind sharing
Yeah.
a bit about that conversation.
Yeah, so I had someone come in to kind of wash my carpets, renew them. We try to do that once a year as a family, sometimes even wash our sofas and that kind of stuff. And we got to talking because you know me, I love to talk about personal finance. I always say that, money is not the most important thing in the world. Finance is not the most important thing, but it affects everything that is important to us. So it tends to come up in any conversation. And so we were talking about the job that he does, and I asked him if he's self-employed or whether he's employed because it was actually my wife that actually booked the services, so I didn't really know much about him. And ultimately, he said, "Oh, he's employed," and I said, "Oh, that's fantastic. You're doing a great job. I hope you are building wealth. You are contributing towards your pensions, your rises, and all that good stuff." And he said, "No, no, no, no. I don't put any money into my pensions." And you can imagine the horror in my face. You can imagine. I just said,
I know you,
"What?
bro.
What? What do you mean?
What?
What do you mean you're not paying money to your pensions? I don't understand. Explain to me." And he said it confidently. I think that's what kind of threw me off. He said it confidently, like, "No, I don't pay into my pensions." And I suspected, Peter, that he was going to say something like, "Oh, I probably won't even have access to my pensions when I'm older anyway," which is a misconception I hear some people actually make about a state pension versus your personal pensions. That's one mistake. But actually, he was saying that he doesn't invest, or he hasn't put money into his pension, or he's opted out of his pension because he has a faith. He's Muslim. And according to his faith, he is not allowed to earn interest. And in his pension, he earns interest. And for that reason, he's decided, this is against my faith. This is, I believe the terminology is haram. And so for that reason, he opted out of his pension. And you can imagine that was a great opportunity for me to provide him with a level up type of education.
I love it. I love it. I love it. I mean, just for maybe our listeners, and we have listeners all over the world, or just maybe listeners that may not really be aware too much in terms of opting in, opting out, all of that stuff. Do you want to just give a general
Yeah.
overview of what that actually means before we even go back into this
Yeah,
convo?
yeah. So for most people that are employed all around the world, particularly in the Western world, there are systems in place, regulatory standards in place where if you work for an organization, they are mandated to actually open up a pension for you and contribute some money into that pension and also take some of your salary and put into that pension pot as well. And so here in the UK, we had something called auto enrollment, which came in April 2012, I believe, which was that mandate where organizations had to create these pensions for people as long as they satisfied certain criteria. So they were over the age of 22, they earned about £10,000 a year minimum. They had to create this pension, and the company itself had to contribute at least 3% of the employee's salary into that pension. That's free money,
Mm,
3%. And then the employee themselves will have to contribute around 5%, totaling 8% of the employee's salary that goes into this pension pot. And this is all tax free. This is all
mm.
tax free, and you grow this pot over time. And then when you hit the retirement age, you are able to live off this asset base in retirement where you no longer want to work or can work. So that's what it is, and this is quite common all across the world in the US and in different areas. And so for me, hearing that he's opted out, the first thing that came to my mind was, bro, you've literally stopped earning or stopped gaining free money, and also what are you actually doing to put yourself in a position where you don't want to be cleaning people's carpets anymore, for example?
Mm.
What are you going to do? How are you going to retire comfortably? And that was, of course, the basis for our further conversation.
I love that. I love that. And I know, obviously, when you open this conversation up, you spoke about that particular person saying they don't put money into their pensions, particularly because of what they believe in faith-wise as well. And as you said, it was an opportunity to talk more. Before I do that, and I know our listeners really want to hear more about that as well. Actually said, putting in money into your pensions is an opportunity to do that. Well, generating income or grow your wealth tax free. What do you say to the people that say, yeah, but I'm going to pay tax after it's grown when I need to take it out in 20 or when they retire,
Yeah,
essentially?
yeah. It's a very, very common misconception and an idea that people have that actually, well, of course, I'm not taxed on the way in, but I'm going to be taxed on the way out. So, what is the point? I think the first thing I would say is here in the UK, you are able to take out 25% of that pot or of the value of that pension tax free, right? It's called a pension commencement lump sum, PCLS. If anyone wants to know the technical terms, so you get to take that 25% tax free and do whatever you want with it. Some people use it to pay their mortgage. Some people decide to go cruising. Whatever you want to do, that's up to you. And then the 75% that's left, you pay a level of income tax depending on obviously your tax band. The problem is people think that's the same. If you're getting tax free early, then why are we getting taxed at the end? But what they don't understand is that the tax free deposits that you've been making and your employer has been making, if you are employed, that has been compounding over
Mm,
many, many years. And I can, with a 99.9% accuracy, tell you that the tax you're going to pay on the way out is not even close to the benefit of the
mm,
compounding that you've got by having that tax-free contribution. So
mm.
that is a misunderstanding. And if people don't want to believe me, just sit down and do the maths. And you would realize that actually the compound of the many years by far outweighs any tax that you'll be paid in the future. And the last thing I want to mention, Peter, as well, as someone obviously who's a financial planner, is at that stage, at retirement, that is the perfect time, in my opinion, to seek the services of a regulated financial planner. Because
Mm.
that's when we could be very strategic about how we're going to divest and how we're going to use your pension pot in the most tax efficient ways, because you can access these pensions very flexibly. Yeah, here in the UK, there was something called pension freedoms. Now we have different ways of which we can access those pensions. We can access them in a way where we pay no tax, in theory,
Mm.
right? So that is a great time. So I think the misconception of where you pay tax at the end is very much misunderstood, and it's definitely not a reason to not put money into your pensions, in my opinion, anyway.
I love that. I love that. Now, thanks for clearing that up as well. And I guess, I mean, initially when you first mentioned that this gentleman said, he doesn't contribute, I just was thinking he was going to say because he actually wants the money there and then.
Yeah,
And yeah, forget the free money that employers add on to it as well. So that's what thought you was going to say. But no, you said he had other reasons, which was around particular faith that he observes. Do you want to just talk a bit more about that and then we dive
yeah.
into
Yeah,
it?
yeah. So interestingly, I thought that was the same thing. I thought I was going to
Mm.
hear, oh, I want the money now, or whatever, which would have, created another conversation anyway.
Yeah.
You can imagine. But yeah, ultimately he was talking about his faith, and I've actually studied his faith. I'm not of the faith, but I
Mhm.
understand it, and it's essentially where you can't earn interest, right? It's called riba if people want to know the
Mm.
technical terms, and essentially by earning interest, that's against the faith. Put it simply, you're not allowed to earn interest, which is true in a sense that when I say it's true, if he stays in his company's default fund, and if you want me to explain that, I can in a bit more detail. But most people, when they do pay money to the pension, is that's it. They don't do anything else. They don't look under the bonnet of how that pension is actually being invested. And of course, there is a huge financial literacy gap where people just don't understand how pensions work. So someone like him, he just believes that this is a pension pot. He understands this is an investment, but he doesn't understand that the investments can be changed. And so he
Mm.
remains in the default fund, which most of the time does have some bonds in that fund and some interest bearing securities as well. So he's absolutely right. Of course, if that's against your faith, why would you want to put money into something that is against what you believe? So he
Mm.
has made a decision that makes sense to him. However, this is where I believe I've changed his life.
This guy.
Yeah, no, and I sat him down and explained to him the things that he can do, that will best, suit his needs and what he's trying to
Mm.
achieve without actually just having to opt out of this free tax free money that you can compound over many years.
And essentially that's what it is. I don't know how old this chap is, but if he's looking to maybe dip into that money in 20 years, that's 20 years worth of money that's been that could have been compounding,
Yeah,
had he still had that same thought process. As you said, a thought process which in theory, when you break it down in the simplest form, it's based on facts.
yeah, yeah,
The money that was invested in terms of those pensions, it had interest bearing assets like bonds, etc. So
yeah,
it was, but what he didn't do, which is going beyond that, is looking at what else can he do, and
yeah,
this is what we're going to talk about. But you mentioned before, if I want you to explain it for the audience, I guess some of those default funds,
yeah,
in terms of what does that mean? Because I'll be honest, I know I've come across a lot of people that have been working for 10 plus years and
yeah,
they've never once looked at
yeah,
what their workplace pensions is money is going into.
yeah.
They can't tell you what they are invested in, and it's their money that they're investing in.
Yeah, I think that's most people.
Mm.
Which is why we do what we do. I level up
Mm.
financial education, where we try to inform people about the options that they have. So the lifestyle fund, when for most or many organizations, when you have a pension pot, that pension pot is usually outsourced to like an insurance company, right? So just a few examples: Aviva, Legal and General, Scottish Widows, Standard
Mm.
Life, Aegon. These are all types of organizations that some businesses will outsource their pensions to. And a very common one as well that's kind of tied to the government is Nest as well.
Mm.
And so when this kind of pension is outsourced to them, they just put everybody into something called a default fund. As the name suggests, this is just a fund that everybody goes into. And it's a lifestyle fund in the sense that it kind of knows your age, and there's a idea that the younger you are, the more risk you can take, and the older you are, the less risk you can take. And in kind of like what we call portfolio construction theory or ideas, essentially bonds are seen as less risky, and equities or stocks are seen as more risky, even though stocks provide more return, they're more volatile. So we measure risk by volatility. Whereas bonds are a bit more smooth. So what happens is the older you are, the more you have in bonds. If we're 30 years old, for example, it's quite common that a 30-year-old will have a 30% allocation to bonds and then a 70% allocation to equities. And then as you get older, they change that kind of mix around to being more bonds. So maybe when you're older, it'll be 70% in bonds and then 30% in equities, etc. And that used to be the standard. It used to be a good practice, to be honest. When I think about it, it was good practice. And that's because earlier on, before I mentioned something called pension freedoms,
Hmm.
before that came, I think it was 2015. Before that came, most people had the same way of basically retiring, which is they would use their pension pot to buy an annuity, right? And that annuity would just guarantee them an income for life. So actually, they needed to basically move their investments into cash to make that purchase, which is why
Hmm.
that allocation was changing anyway. However, nowadays, because of pension freedoms and the fact that we can access our investments flexibly, most people are going to keep their investments or their pensions invested throughout retirement.
Hmm.
And then they're going to draw, as and when they need the resources to live off, etc. Right? So it doesn't make sense to be in a lifestyle fund. And depending on your circumstance and how your other assets are working, you can take more risk or you may want to take less risk. So we need to be a bit more bespoke, right? But that's what a lifestyle fund is, and I would encourage most people to look under the bonnet of their pensions. Actually, check your statements, right? The thing that comes across once a year to see how it's invested, and ask yourself whether you want to make that change, because actually maybe being in a 100% equity portfolio might actually be better suited because you're young, and actually that might be the best way to go, for example. So I hope that kind of explains what the default fund is, which is the same as like a lifestyle fund. the
Hmm.
default the default fund is a lifestyle fund often, and for a lot of people you may want to actually change that around.
Yeah. And you mentioned, check your annual statements, which comes in the form of a letter. Most people, I don't, most, I've been on lots of different workplace pensions, but most people will have access to create an account where they can log in
Yeah,
online and check these things as
yeah,
well to really understand what's going on, what they're being invested in, how the investment is growing or not growing, all of that stuff. So yes, it's interesting and it's something that everyone can essentially do.
absolutely, absolutely. For those that might have a very sizable pot and you don't understand how to do this, you don't really know what you're really looking for. Hey, that's when you can seek the services of a financial advisor who can,
Hmm.
actually dive into the details of your pension, the fees, how it's invested, and maybe advise you on what best to do as well. So that's another option for people that want to go a bit deeper and
Mm.
maybe a bit older, maybe have a really sizable pot, and maybe you are approaching retirement and you want to make sure that you're doing the right things as you approach the time where you actually need the resources.
Absolutely. Okay, so let's get back to this chap. Let's
Yeah.
call him Chap X or so, whatever. But yeah, so you found this out, right? And he said, "Listen, Jax, man," and he said this so confidently. It was just not even a slip of the tongue. It was just confidently.
Yeah.
That yeah, I don't really put money into my pensions because it earns interest, etc.,
Yeah.
etc. Let's hear a bit more about your guided response,
Yeah,
so to
it wasn't
speak.
financial
Yeah.
advice. It was just a
Yeah,
friendly,
absolutely.
a
It
friendly
was a
piece of
conversation. Yeah.
education
Hmm.
to the guy. No, so I said to him, "Look, I understand where you're coming from, but there are specific portfolios or funds that are designed with certain ideas in mind. For example, your faith, for example, your beliefs. So, yes, we're talking about your faith being Islamic. There are specific types of assets that or funds that you can invest in that are what we call Sharia compliant funds. So you can still invest in your pension, but actually within that pension portfolio invest using something called a Sharia compliant fund. And he was surprised. He said, "Oh, is that exists?" And I said, "Well, yeah, it's a solution to the problem that you're obviously facing, right? So go do some research, speak to your employer, see if the current pension provider you're with have these assets in place, and if so, then very simple, you can actually look to switch into so switch away from the lifestyle fund into the Sharia compliant fund, for example's sake. But I think this also speaks to most people's situations. It's not just
Mm,
his situation, because a lot of people have very unique belief systems, ideas, wants, aspirations, things that they don't want access to, they don't want exposure to. So a big part of one of my recent roles, when I worked for like a charity investment manager, was we will invest for charities.
mm,
And we have some charities that are for the animal charities, for example, and they don't want any exposure to any company that does animal testing, right? And so, again, as an investor, you can decide to invest in some of these more socially responsible funds, and be mindful of that as well. So, I guess what I want to say here is never let the fact that you don't want to be involved in what already exists and what you know to exist, never let that be the reason why you completely opt out.
mm.
Always ask the question. Always see if there is a solution for your unique circumstance.
Hmm. I love that. I love that bit. It's okay, I can't do this, but is there anything else I can do? And
Yeah.
it's actually asking that question rather than closing it, because yeah, as we've just highlighted, there could be a lot of missed opportunity.
It would have been an absolute tragedy
Mm,
if he. I don't know his age, but if I had
yeah.
to guess, he'd probably be in his mid 30s, right? So
Hmm.
he's still quite young, and it would have been an absolute tragedy if we're having this
Mm,
conversation 40 years, 30 years down the line, and he would have had this mindset for multiple decades. Of course, we also believe that once you know better, you can do better.
hmm.
We would have missed out on all those years of potential compounding and investing in what he actually believes in, and earning a return from it, not in the way that goes against his beliefs.
No, I love that. I love this conversation. And as you say, it sparked even a bigger discussion about, in general, people opting out of things like this, in terms of putting money into pensions as well. And I guess for our listeners, I mean, we got listeners from different parts of the world that tune in. If you can either relate or have any further questions or thoughts or comments, we're obviously on YouTube now. So make use of it. Actually, send it through, or contact us via our other socials as well, because we definitely like to keep conversations like this going, but also encourage you to have these conversations with your network as well. So no, that's really, really, really good discussion, Jax. And
Yeah.
talking about other parts of the world, historically, in our previous brand, we like to give a shout out to where we're getting listeners from. It might be a new city, or it might just be a place we've not given a shout out to where we got listeners from. And this
And viewers
area,
now, by the way. I'm viewers, so it's not
and
just listeners.
viewers, not even just listeners, viewers now. We've
Yeah.
we've we've switched things up, so we've got viewers as well as audio listeners as well. So massive shout out to you all. But no, Jax, this city is called Dhaka, which is in Bangladesh.
Oh, fantastic. Fantastic. Okay, so welcome to the Level Up. I was literally about to call it the old podcast, but welcome to the Level Up Financial Podcast. You're here with myself, Jax, and my very good friend, my co host, Peter. And on this podcast, we talk about all things finance related. By the way, if you want to know more about what we do, because we do have a business outside of this where we provide financial education to even young people, do head over to www.levelupfinancial.co.uk. That's www.levelupfinancial.co.uk. Make sure you sign up to the mailing list so you are kept up to date with all the amazing things that we are doing. And if you want to engage with us on socials, of course, in these videos, give us a like, give us a comment, tell us about your ideas, things that you would want us to discuss on the podcast. But we are also on other platforms as well. So we are on Instagram. If you search for Level Up Financial, you find us. We are on TikTok, and we are on LinkedIn as well. And we are definitely producing a bit more content nowadays. So make sure you do engage with us and befriend us on there as well. So welcome to the podcast. I hope you are enjoying it, and I hope you are gaining tons of value.
Come on, come on, come on. A massive shout out to our viewers all over the world, man. We see you, we appreciate you, we recognize you, and we're grateful to you, man. So thank you very much. Jax, man, been a good conversation though. I think any other thoughts that come to mind on this particular topic for obviously the specific situation, but also the wider
Yeah.
conversation around this as well.
Look, I'm more interested in the wider conversation.
Mm,
I think the challenge that I come across a lot of the time, Peter, is a lot of people make they have reasons why they've done something that they know should be good.
Mm.
So in this example, they've opted out of a pension, which they know should be a good thing, but they've done it because of X, Y, Z, right? And I think what I said earlier was whenever we make these decisions that have implications long term, we should always ask more questions. You know, what is the alternative? What else can I do? And what am I giving up? Right? So you might find an alternative and say, I'm looking to buy, I don't know, a property portfolio, for example, but understanding that, for example, the tax inefficiencies of property or the lack of liquidity in property versus pension. So always ask the question if you are uncomfortable with the knowledge base and you don't really understand what you're even asking in the first place, seek a professional to give you the advice, right?
Mm.
Or come and listen to more episodes of the Level Up Financial
Come
Education.
on.
In fact, what I would say is leave a comment in any one of our videos. We will check the comments and we will get back to you with education. We don't give financial advice, we don't give investment recommendations, but what we do is we give information, our own opinions and guidance as well. So that's what I would say. There's always a solution, I would
Mm.
say. So yeah, don't jump into conclusions.
Come on, come on. That's it, man. So yeah, hopefully our viewers, you've enjoyed that. Keep staying involved, keep the conversation going, and we look forward to seeing you on our next episode. Let's keep leveling up, man. Until the
Level
next
up.
time.